Anyone who tells you they can time the market is either a god or lying. You cannot time the market in the short term. So, what is your own investing mantra? Data from the past 20 years shows that if you had invested 33% in large cap, 33% in mid cap, and 33% in small cap, your risk would have been slightly higher than just investing in large cap, but your returns would have been similar to mid cap returns. However, one thing I definitely want to mention here is, don't go crazy behind investing. It's very important. You don't want to die rich, you want to live your life. A loan company needs a history to determine whether you can repay the money or not. If you have never taken a loan, they have no history. It's like needing a good job to get a good job. It's a loop. In many podcasts, they talk about what to do, but the topic of this podcast episode is what not to do because I think it's so important. In finance, if you understand what not to do, the rest becomes much easier. What I've noticed is that people, especially the younger generation, are rushing towards investing very early in their careers. Before starting to invest, there are two things they should sort out first. Risk management. Imagine you are 21 years old, you just got your first job, and you are earning 50,000 rupees. You start in SIP of 10,000 rupees. After 5 years, you accumulate 6 lakh rupees. Unfortunately, if you or someone in your family faces a medical emergency, you will realize that 6 lakh rupees is not enough for medical expenses in India today. So, before investing, you should first get medical insurance. This is very important because when you are young, the cost of medical insurance is very low. If you start investing in medical insurance early, you will never face such a situation, and you can invest your money in a disciplined manner because your medical risk is taken care of. Term insurance. As soon as you start earning, you should get term insurance. Your family indirectly depends on your income. If something happens to you, your family needs protection. The cost of term insurance will be much higher if you get it later in life. The cover should be at least 10 times your income, but 20 times is the best proposition. Many people make the mistake of taking investment-led insurance instead of term insurance, which provides very little cover. You should only take term insurance. Before you start investing, always make sure you have an emergency corpus. The logic is the same. If you lose your job, you should have enough to cover 6 to 12 months of expenses. This emergency fund should be liquid, so you can access it immediately. You can keep it in a savings account, FD, liquid funds, or arbitrage funds. Medical insurance. If you live in a metro city, you should have at least 20 rupees 25 lakhs of cover. You can take a family floater policy, which covers all family members. Medical expenses in India are increasing at a skyrocketing rate. The medical inflation rate in India is 12%. If you think you can't afford a high cover, you are mistaken. The incremental premium for a higher cover is very low. Life insurance. Apart from term insurance, don't invest in any other life insurance products. They are not good investment tools. For example, my dad invested 5,000 rupees every year for 21 years and received 2 lakh rupees at the end. This is a return of 5.8%, which is very low. Instead, you could invest in PPF, which offers better returns and tax benefits.